I wanted to now introduce our two speakers today. We're so happy to have Fanila Chang and Gina Di Giusto. Fanila is a staff attorney at HERA. She engages in direct legal services, policy advocacy, and impact litigation with a focus on issues pertaining to home preservation and foreclosure prevention. Prior to joining HERA, Fanila spent 4 years as an attorney at the U.S. Department of Housing and Urban Development. Born and raised in the Bay Area, Fanila received her BA from UCLA and her JD from Georgetown Law, where she was a public interest fellow and an editor for the Georgetown Law Journal. Gina Di Giusto is a senior attorney at HERA and a graduate of Harvard Law School. Prior to joining HERA in 2013, Gina provided advice on landlord-tenant issues at a local legal services program. She completed a fellowship at the Superior Court in Alameda County and spent 2 years representing residents of publicly subsidized housing before local housing authorities. At HERA, Gina works on unfair debt collection, wrongful credit reporting, mortgage and foreclosure-related issues on behalf of Californians in need. Gina also brings significant litigation experience and expertise addressing abuses by homeowners associations. So gosh, we're so happy to have both of you here today. And just so that everyone knows, we will be taking questions at the end. Please feel free to put your questions in the chat and we will respond to those at the end of the training, given what time we have, because there's a lot of information. And if they're too personal questions, we may just refer you to go to HERA to get some personal information. But I'm going to go ahead and let, I think, Gina, maybe you're the first one, or Fanila, I don't know who's going to start, but take it away so much.
Thank you, Beth. Sorry to give you such a mouthful. And welcome to everybody this morning. We're really excited that you carved out some time for us. There's a lot of material that we're going to cover today. So if there's more detailed questions that you have or something that we didn't cover, please go ahead and put it in the chat box. We will try and answer as many questions as we can at the end. If we don't get to everybody's questions, I will make sure we follow up, get you those answers that you seek. But we're going to try and cover a lot of ground today. Just so that you all know, I'm going to, on the last slide of today's presentation, we're going to put up a list of the services that HERA provides. We're a local nonprofit housing and economic rights advocates. We are mostly attorneys providing legal advice on many different consumer issues, including home ownership questions. So please feel free to contact us directly if you want some one-on-one advice. So today, we're talking about starting out as a first-time home buyer and some things that you should probably know and consider before embarking on that journey. So I just out of curiosity would like to put up a poll to see where everybody is. Are you currently in the home buying process, or do you plan on being purchasing a home in the next 12 months? I'm going to give everybody a second to answer this question. I'm just super curious. It looks like the majority of folks here are in the process, looking for homes or about to start the process. So this should be very relevant to everybody here who's participating today. So the first thing that you should really be focusing on, if you're just starting out, you're beginning the journey, or even if you're right in the middle of it, one of the most important things that you can do to prepare yourself for this process is above and beyond, get your credit in order. And I would say some of you may have already participated. We've done a workshop or several workshops before on credit reports and reviewing credit reports. I strongly recommend that you also check those out if you can. I will cover some of that material today, but if you want a really at length, full conversation about credit reporting, go ahead and check out those workshops as well. So credit, the reason why I always start with credit, one is because it takes some time. If there's some issues with your credit or your credit report and you need to address some issues before starting on the home buying journey. And the reason it is so important is because, quite frankly, it's going to be have a huge impact on whether or not you're going to successfully get a home loan if you need to borrow money, which most of us would and do in order to buy a house. It's going to have an impact on the interest rate that you are offered on a home loan. And in addition to that, it's also going to have an impact on how risky of a loan you might be eligible for, if there's other reserves or money that you're going to have to put on the table when borrowing. So it makes a huge difference in terms of what options are available to you. So getting your credit in order, understanding your credit is very important during this process. So what is a credit report? A credit report, and the reason I start with credit report, I always like to say this, most people just focus on the score and what number they have, but actually your credit report is what you really should focus on, because your score is just a numeric representation of what's on your credit report. So I start with talking about what's in your credit report, because that in turn is how they figure out what score to give you. So just keep that in mind. So your credit report is a whole summary, and it's all this information about you that kind of indicates whether or not you're a risky borrower, your credit worthiness, as they say. And so one of the things that you will find when you pull your credit report is that it may seem like they have every little bit of information about you that you can think of. So not only will they have all the names that you've ever used when applying for lines of credit, you will see any public records about you that are out there. So if you have any evictions in your past, if you've been sued in the past on some type of debt, if you have tax liens, this is all going to show up on your credit report. You're also going to see if you have fallen behind on your bills and you are dealing with debt collectors, that will show up on your credit report, as well as credit accounts. So any line of credit that you have in your name or have had in the last 7 to 10 years is going to show up on your credit report. So mortgages in the past, student loans, auto loans, credit cards, anything where you borrowed the money, it's probably going to show up on your credit report. And then the final item that you're going to see on your credit report are inquiries. What that is, that section will indicate if you've applied for lines of credit in the last few years, where you applied. So lenders can even see if you've been trying to pull additional credit. So it's a lot of information and can be overwhelming, but it's good that you understand how much information is there and what to do about it, just so that you know what you're facing if you're trying to improve your credit. So even though there's a lot of information that may seem daunting, you actually do have a number of rights with regard to your credit report. The most important, and quite frankly, if you're in the process right now of buying a home, I really hope that you've already taken this first step, and that is to pull your credit report. So you actually have the right to pull your credit report for free from each of the 3 major credit reporting agencies. So that's Equifax, Experian, and TransUnion. Typically, you can only pull it once for free once per year. So for example, if I pulled my TransUnion report today, then I wouldn't be able to pull it again until next January for free. However, because of the pandemic, all 3 credit reporting agencies are allowing you to pull your credit report for free per week until April. So I strongly recommend that you go ahead and do that. I recommend that you go, if you're going to pull your credit report, I would go to annualcreditreport.com. That is the website that is approved and sanctioned by the Federal Trade Commission. There are a lot of websites out there where you can pull your credit report, but I recommend that you go through annualcreditreport.com, because you can pull any one of the 3 major reports on that site. You shouldn't have to pay for it. You shouldn't be pulling out your credit card to pull your credit report. That's the right way to go to do it. So first step, go ahead and pull your credit report if you haven't already. The other right that you have is that you can, not only do you get a copy of your report, but you have a right to have errors on your report corrected. So just because they're collecting information on you doesn't mean that they have a right to report incorrect information. So once you've pulled your report, make sure you review it and check for any errors and address those errors. I have a checklist on the next slide as a quick reference to of the things that you're going to want to look for in terms of errors, but you're going to absolutely want to get those errors corrected. In the materials for today's presentation, I also included a more at-length checklist as well as some instructions on how to dispute those errors if you'd like them. We also at our office help people dispute errors on their credit report if you need a little bit of extra assistance. But make sure that the information that is being reported about you is correct, because you don't want to be penalized for information that's not proper. If there's accounts that don't belong to you, or if they're saying balances are wrong, you want to make sure that everything, all the information about you on your report is accurate. It's very important. The other few rights that you have with regard to your credit report, if you're a victim of theft, for example, and let's say there are accounts on your credit report that don't belong to you or are a result of identity theft, you have a right to have those addressed. We can help you if you need to make a report and contact the credit reporting agencies to make sure that those items do not appear on your credit report, because again, we don't want you held responsible for something that isn't your fault. You just want your reports to be very accurate. The other point, which is very helpful to many people, is that you have the right to have very old information removed from your credit report. So negative information, normally, you can't, if the information is accurate, you don't have a right to have it removed. However, after 7 years, negative information does eventually fall off your credit report, or it's supposed to. So if you see negative information on your report that's more than 7 years old, you should dispute it because you have a right to have it removed. The one exception would be bankruptcy. If you filed for bankruptcy, that stays on your credit report for 10 years. Otherwise, all other negative information should fall off or be removed upon request. So that's the good news if you did maybe have some items that you were struggling with in the past. And then your final right is that if, let's say, someone is abusing access to your file, they're reporting information that's incorrect, they're misusing your data, you do have the right to bring an action, legal action against those individuals if they're not correcting the errors, for example, or if they're misusing your data. You do have some protections. So if you think that your information is being misused, or if you're a victim of identity theft, or if there's errors on your credit report, you are not out to sea. You do have protections. So keep that in mind. Okay, so just briefly, when you're reviewing your credit report, here are the things you really just want to quickly make sure are correct. You want to make sure all your personal information is correct, all your phone numbers and addresses, make sure, because sometimes if there's information there that doesn't belong to you, who knows, you may be a victim of identity theft or have a mixed file, as they say, where your information is being mixed with somebody else's credit report. So just make sure your personal information is accurate. Also make sure that all account information is correct. Any accounts that you've opened, credit cards, you want to make sure that if it says you were delinquent on a month, that make sure that the timing is correct. If you weren't delinquent, get it corrected. Make sure the balances look correct on your report. It's really, really important. Get rid of all that old information if possible, especially the negative information if it's more than 7 years old. If there are delinquent accounts, meaning that you are in collections or dealing with debt collectors, you want to address those debts. The loan or as part of the closing costs have to pay those debts in full. I have seen that happen where one of the terms in order to get a loan is that you had to pay, make sure you pay off your delinquent accounts first. So you want to address those as soon as possible. And then of course, check for signs of identity theft. All right, so once you've reviewed your credit report, you've pulled it, you've gotten rid of the errors and addressed any negative information, you're probably still wondering, okay, how does this impact my score? There's a lot of information there. How do they come up with a number? And so I like to throw this in there just so you have an idea, have an idea of how those scores are calculated, because it may impact some of the ways you use your credit. So for example, there's really two major credit score companies. So you have your FICO score and your Vantage score. And in general, what they consider important on your credit report is roughly the same. So for example, payment history is very important when calculating your credit score. Do you pay your debts on time? Have you fallen behind during any months? How long have you been behind? Payment history is very, very important. So the number one thing you can do to try and build up your score and get yourself ready to buy a home is pay your bills on time. Seems kind of obvious, but it really does weigh heavily on your score. The next thing that these scores will factor in, so for example, with your FICO score, they're going to take a look at how much you owe, not only in total, so the total debt that you carry, but how much you're using your various lines of credit. So if you're maxing out your credit cards, then that is going to have a lower, it's going to lower your score or have a negative impact on your score. Whereas if you're more conservative in how much you spend on your lines of credit, let's say you only use 30% of every line of credit you have, you're going to have a slightly higher score. So keep in mind the total debt you carry and how much you utilize your cards is going to have an impact on your score. Then for FICO score, they care about your credit history. How long have you been a borrower? Did you open up your first credit account 10 years ago, or did you just open it up 6 months ago? The longer you have had an open credit account, the better your score will be because you have more of a history to judge in terms of your credit worthiness or your riskiness as a borrower. Then part of your score is new credit. So if you open up a bunch of accounts all at once, or if you close a bunch of accounts all at once, that will impact your score. And then the final element for FICO score is that they care about, do you have a variety of credit? The types of credit do you use? Are you somebody who has just a bunch of credit cards, or do you have a mix? Do you have a credit card and some student loans and an auto loan? I'm not quite sure why they care so much about this, but basically the theory is if you can show that you can pay on a variety of different debts, that looks better than if you just have one type of debt. So someone who has, if you're looking at two individuals and they're relatively similar in terms of how much debt they carry, the person who has, let's say, a credit card, a student loan, and an auto loan who's paying on time versus someone with just credit cards paying on time, the first person is probably going to have a slightly higher score. Vantage score, going back to that. So we talked about payment history. For them, depth of credit. So that's the age of your credit accounts and the total amount of debt you carry. That's the 21%. Utilization has to do with how much you're using your lines of credit. So that one is similar to, are you maxing out on your cards, or are you using your lines of credit more conservatively? Then they look at balances in terms of everything total, but also how much do you have access to additional lines of credit, and then recent credit. So if I were to sum this all up, just so you have an idea, pay your bills on time. That's the most important thing. Pay history. Then they're going to look at how much debt you carry in total, how much you use your various lines of credit, and then variety in terms of how much debt you carry. So those are the really heavy hitters and what dictates your score. So keep that in mind. If you have smaller debt balances, if you're not maxing out your cards and you're paying your bills on time, you're probably in really good shape. So now that we've talked briefly about credit, or not so briefly, but now that we've talked about credit, you should start to think about, okay, I've got my credit in order. I know I have a pretty good score. Here are the things that you should be thinking about when you're starting to prepare to budget for a house, what numbers you should be aiming for in terms of costs. So this will help you start to think about what type of loan or how much I want to take on when I'm going out there and bidding on a house. So the first thing you should all be thinking about, if you haven't already, is just making sure that you understand that when you buy a house, the only cost involved with the house is not just your mortgage. You're not just paying principal and interest on a mortgage. You also need to make sure that you understand that when you are a homeowner, you're paying property taxes and homeowners insurance and potentially mortgage insurance, which we'll talk about in a minute, or homeowners association dues. So when you're trying to figure out, okay, can I afford this home on a monthly basis? You need to make sure that you're including all of. Sometimes on those websites where you're searching and you're looking for homes, they'll give you an estimate of the monthly payment. Sometimes they include all of these costs, sometimes they don't. So don't just look at those and think, oh, I can afford this. You really need to make sure that you understand all of the costs involved with that particular home that you're considering. And why this is important is because this is one of the main things that a creditor is going to think about when they're thinking about offering you a mortgage. So there's something called a debt to income ratio that a creditor is, they may approach you and they say, okay, your debt to income is too high. And you might think, what in the heck is debt to income? Debt to income, at least on the front end, they say front end debt to income ratio. What they're referring to is that they have added up all the predicted housing costs for a monthly payment. So everything on this slide, they add up all of these items that they anticipate the rough cost of that home that you're thinking about buying and that loan you're thinking about taking out. And then they use that as a fraction of your gross monthly income. So basically it's the comparison of all of your housing costs to your gross monthly income. And traditionally, for most lenders, they usually want to see a debt to income ratio of no more than 31%. I'm going to give an example of how this looks in terms of dollars and cents as a real live example in a few slides. But just if you're hearing, what should my ideal housing costs be? Or if you're hearing the phrase debt to income ratio on the front end, most lenders, they want to make sure that you're not spending more than 31% of your gross income on your housing costs. The other ratio that's very similar that a lender is going to worry about is what is your back end debt to income ratio? So what they do is they take all of the housing costs that we just talked about, they add in any of your installment debt. So basically all your other debts, your credit card payments, your personal loans, your student loans, all of that extra stuff you pay per month. And then they take that and they compare that to your gross monthly income. And so that figure is your back end debt to income ratio. And typically lenders don't want you to be beyond 40 to 45%, which if you really think about it, it actually means that your monthly debts other than your housing costs really can't be too high. So if you're carrying a lot of student loan debt or you've got really big bills in terms of auto loan payments, this may be very difficult for you. Some programs are very specific about what ratios they're looking for. So I would recommend that if you're in the process, you're speaking to a lender, you're looking at potential loans, one of the things you're probably going to want to know and find out is what debt to income ratios they are looking at. What are the metrics they're using? Are they making sure that your debt is no more than your front end debt to income ratio is less than 35%? Is it 40%? You want to know what ratio they're using because that will dictate how much of your debt is being held against you if you're in the ballpark, if you're likely to get that loan. So here's what it looks like practically speaking. So here's an example. We have a couple. They're looking for a home. Their gross household income is $98,000 a year, in my example. And this lender says, okay, we want your front end debt to income ratio to not be more than 31%. So that's just the housing costs. That mean in dollars and cents. So for this couple, if they make $98,000 a year, that means their monthly gross income is $8,100, a little over $8,100. So on the front end, their housing costs, so principal, interest, taxes, insurance, all those home costs should be no more than $2,531.67. And on the back end, all of their debts combined, housing and installment debts, should be no more than $3,266.67. So in other words, if this person in this family is looking for a home and their income is $98,000 per year, given the ratios from this lender, they really should be looking for a home that's make sure that the loan and everything that adds up is no more than the $2,500 and that their extra debts, so their non-housing debts, are no more than $735. So that extra difference between those two ratios. So, these days, especially during the pandemic, $735 for other installment debts, it might be very tight. If you're carrying student loans, a lot of student loans and an auto loan and credit cards, it might be very difficult to get your extra debts to that $735 level. So keep that in mind. That's how these ratios work, is basically if you're carrying less of the extra debts, then maybe your housing costs can be higher. You can afford a bigger home or a more expensive loan. If you're carrying a lot of extra debt, student loans, what have you, you're not going to be able to borrow as much. So that's how that all works out. And that's what that means if the lender's looking at debt to income ratios. The other figure that's on everybody's mind, and maybe it's the first figure that's on everybody's mind, is the down payment. So most, in the old days, it was always, oh, you have to save up 20% for a down payment. That is kind of the traditional figure that you're aiming for when you want to come up with a down payment. However, there are some options for buyers who do not have a 20% down payment. So for example, there are loans, some loans, they're structured so that even if you don't have 20% down as a down payment, let's say you only have 10% of the loan to put down as a down payment, you can still take out that same loan, but you may have to pay something extra called private mortgage insurance. So private mortgage insurance is basically an insurance premium that you pay to the lender because you have put less money down up front. You are seen as a more risky borrower because you don't have as much stake in the game. And so basically you have to pay this extra premium to the lender because you didn't put as much money up front. And then over time, as you pay down your loan balance and the loan balance drops and your equity in the house grows and you have now more money invested in the property, eventually, once you hit that 20% mark, then you no longer have to pay that private mortgage insurance. So when you are thinking about borrowing money, you may see in your credit offers, if they include private mortgage insurance, it's probably because you haven't put down, or they don't think that you're going to put down a full 20% down payment. So keep that in mind. There's also some other programs. So for example, the Federal Housing Authority, the Federal Housing Administration, so the FHA, they have a loan program where you put down as little as 3.5% as a down payment on a home. Now, with that program, you also have a type of premium that you pay, a mortgage insurance premium. With that program, it works very similar to private mortgage insurance, but it's basically something that you pay extra until you can bring the loan balance down to that 20%, where you've invested in at least 20% into that loan. But it's a great program. It's meant to help folks who are low to moderate income, who maybe don't have a ton of money saved up for a down payment, but it helps them get their foot in the door. It is a very good program. And if you think that you want to be evaluated for that when you're looking for loans, you should ask your lender about these options. The other option is a VA loan. So for active duty service members, veterans, or surviving spouses, VA loans, sometimes you can even get a loan where you put down no down payment, as long as you meet all of the eligibility requirements. So that might be an option. If you haven't quite saved up for that 20% down payment and you're looking for an affordable way to get your foot in the door to buying a home, that might be an option for you. There's also what they call USDA loans. These are for folks who live in smaller towns or rural areas. We don't see a lot of them here in the Bay, but they do exist. They also require smaller down payments. And then the other thing you should absolutely do if you're in the process of looking for a home, especially if this is your first home, you're a first-time home buyer, and you're low to moderate income, a lot of cities and local municipalities have payment assistance programs or excuse me, down payment assistance programs where they will give funding to help you get to that 20% down payment or to get closer to that 20% down payment. And that can make a huge difference in terms of the types of loans you're eligible for. So absolutely go wherever you're looking, look on the website for that city and see if they have a down payment assistance program, because it can be very helpful to some of you. Now, other than whether or not you can swing the monthly costs of that house, they're looking at your debt to income ratios. They're looking at how much you're going to be putting as a down payment. The other thing that you need to understand is how appraisals impact the process. So when you are in the process, you've put a bid on a house, you're being evaluated for a loan to get approved to pay for that house. One of the things that's going to happen is that the lender is going to order an appraisal of the home that you are looking to purchase. The appraisal is just supposed to be an independent assessment of the value of the property. It's supposed to be done by a neutral third party where the lender doesn't have sway over that appraiser. And that appraisal that's done is not necessarily going to be what the going market value is. It's in a separate evaluation where they're really trying to figure out how much they think the home is worth. And so the reason that lenders order the appraisal, and it's very important, is because a lender wants to make sure that any property that you're thinking about buying, that the value of the house is more, hopefully significantly more, than the amount of the loan that you're going to take out, the amount of money you're going to borrow against the house. Because the more money you borrow and the closer it gets the actual value of the house, the riskier that loan is seen by a lender. Because let's say you fall behind on your mortgage at some point, if you have borrowed to the maximum and you lose the house to foreclosure, there's not really a cushion there in terms of the value of the home for the lender to get all its money back. So a lender wants to see how much the home is appraised for to make sure that what they call the loan to value ratio is within acceptable limits. So basically they want to see, hopefully, that the home is worth, let's say your loan is 800. This is a big number, so don't panic, but let's say your home is worth $800,000. They would want the home to actually be valued at $1 million. They want the loan that you're taking out to be no more than that 80% mark. Now, a lot of times that doesn't happen, and you shouldn't panic. Let's say that you're borrowing money and the appraisal says that the loan to value, meaning how much you're going to be borrowing, is closer to 85%. It doesn't mean that you'll be denied for that loan. What will likely happen is that the lender may require that you have to comply with more strict standards. Maybe you have to put down more of a down payment. Maybe you have to have extra money in reserve. A lender will tell you if they think that the loan to value is too high, then they may want to see some extra things from you as a borrower. And then if the appraisal comes in where the home is worth less than the loan that you're going to borrow, that is the point where you may either want to circle back to the seller and see if they will reduce the sale price, or if they really won't budge. I would really think long and hard before committing to a home where the house is worth less than the loan, meaning that the house is underwater, you owe more than what the house is worth. That's a very risky position to put yourself in. You really don't know what will happen to your home or what the market will look like down the road. And I really wouldn't want to see you start out the process where your house is worth less than the amount of money you're going to be paying for it. So if that comes in, or if that happens, that's kind of a red flag in terms of either trying to get the seller to work with you to reduce the sales price, or maybe you just cut your losses and walk away from that particular house. And finally, so you've now checked, can I afford the monthly payment? Do I fit within the debt to income criteria? Is the house, worth it in terms of value? The other thing that you really need to make sure you're thinking about if you're trying to set aside money for buying a home is the closing costs and all these extra fees that are involved. So not only do you need to come up with the money for that down payment and make sure that your monthly income can cover the regular payments, but closing costs can be very expensive. They can vary drastically between lenders. I've seen anywhere between $12,000 and $20,000 for closing costs. It can be a lot of money. So you need to make sure that you're also setting aside money on the front end to cover those closing costs, because if the lender doesn't think you have that money set aside, or even if a seller realizes that you don't really have the money set aside to complete the sale and pay the closing costs, it will make the deal fall through. So closing costs are stuff like the appraisal fee or a credit report fee or application fees. Other lenders, some lenders also, for example, as part of the closing costs for a loan, they want you to put up front, 9 months, 6 months, 9 months worth of property tax payments or homeowners insurance. So normally you pay as you go along for those items, but at the beginning, the lender may want you to front some of that money. And so it does make a difference. Make sure you check with any potential lender to see what their closing costs are and what they include. For example, do they make you pay for 6 or 9 months of property taxes up front? Because that will make a difference. The other thing you're probably going to have to, or you will want to pay for and get during the home buying process is for title insurance. When you're looking to buy a home, you hire a title insurance company. What they do is they pull the title records for that house to make sure that whoever is selling you the home has the right to sell you the home, that there aren't any other claims on the house, either liens or debts or other individuals who might have a claim to the house to interfere with your ability to own the home outright. And so title insurance, they do these checks, and then depending on what they find, as long as you address those issues up front, if first, for example, you own a home and then down the road, some other third party pops up that wasn't flagged during that initial review, title insurance covers that to make sure that they deal with any potential claims, third party claims to the house. So ideally, when you're buying a house, you really want a clean title report. You want clear ownership. You want to just see from one person or a couple to the next. You really don't want to see very complicated ownership, previous ownership arrangements. If possible, you really want it to be clean, but you have to pay for title insurance for that. You also are going to want to pay for home inspections. This is a huge purchase, a huge commitment. When you go and buy a car, you kick the wheels, you check it out, you make sure the buttons work. With a house, you want to make sure it doesn't have termites or mold. There's not some huge damage issue that you're going to have to address when you first move in. So you're going to want to pay for inspections, and those are not cheap. All the inspections that I've listed here, it's not uncommon for those to be $1,000 or maybe a little more than that for all of those inspections. So keep that in mind. You're going to need money for inspections as well. And then let's say that they do discover something that needs repairs. You're going to want to need to have some money set aside to address those, because a lender may want some of those issues repaired. So keep in mind, when you are out there thinking about buying a house, make sure that you're not using every last penny that you have just for the down payment. You're going to want to set some aside because there's all these extra costs involved with buying a house. So just make sure that you don't push your budget to the maximum. Make sure you set aside some extra funds for these other things. So you've checked your credit. You've now looked at the numbers. You've crunched the rough numbers. Now is the time. Before you go and bid on a house, I strongly recommend that you shop around for your loan. So a few things. The first thing is that you should always try and shop around for at least 3 different potential lenders. So make a list of lenders you've heard of, ask your friends who they've had good experiences with, and write down a list. It could be community banks, credit unions, online lenders, and you're going to want to either apply or at least consider 3 different lenders. Then once you've kind of selected at least 3 different potential lenders, then you will probably be assigned a loan officer who you can talk to, and they will talk to you about options that they recommend for you based on your criteria and your background, the costs and benefits of the various programs. And then they're going to give you an actual loan estimate, which I'm going to allow Fanilla to jump in. She's going to talk about loan estimates in just a few more slides. So when you're considering a potential lender, it's not just about the cost of the loan. You also do want to think about that particular lender. And the reason it's important is because when you are trying to close on a loan for a house, depending on who your lender is, that can really gum up the works. Just because a lender is one of the big box lenders that's very well known, a Wells Fargo, a Bank of America, a Chase, what have you, a really big lender, it doesn't always mean that that is a surefire bet that you're going to close on time, because sometimes big lenders, they take longer, or they don't value their customers as much or give you as much attention. So sometimes they will take longer to close on a loan than, let's say, a local lender or somebody who just is like a credit union who's only lending to a smaller community. So when you're looking at potential lenders, don't just look at the name of the lender. Also think about, is this lender local? Are they easily available? Can I get a hold of my loan officer very easily? Because that's the person who's going to be your go-between during the whole process when you're trying to buy a house. If they're very difficult to get a hold of, or if they do not like to answer your questions up front, that is an indicator that they may not be who you want to work with in terms of a potential lender. Because if you're trying to close on a house and time is ticking and you're under contract to try and close your house within a certain amount of time, if you can't get a hold of your lender, that's a really big problem. So on the front end, if you're getting the sense that this is not somebody who values your time or gives you the time of day or answers your question, I would strongly hesitate going with that lender, even if they're like a big named lender that you're very familiar with. So one thing you could also do is ask that potential lender up front, what's the average amount of time it's taking you to close these days? If you put in your contract that you're going to close on a loan to buy a house in 21 days, but on average that lender takes 40 days, that's something you should know up front, because that means that you are setting yourself up for failure and to close late, or potentially have to back out of an agreement with a potential seller because the lender's taking too long. So make sure you ask that question up front. And then the other thing you can do on the front end, once you've decided that I'm comfortable with this lender, confident that they will take the time and work with me and be responsive, is you may want to go ahead and do what's called either a pre-qualification or a pre-approval. Pre-qualifications with lenders means that you have given them some information about you in terms of roughly how much income you make, roughly what your credit score is, how much debt you pay, installment debt you pay every month. And then based on that information that you've self-reported, they'll say, well, we think you're roughly qualified for this amount of a loan. That is not as strong as a pre-approval, where you effectively give permission to the lender to pull your credit report and send them proof of your income, and they pull proof of your debts. And so they look through your finances a little bit more closely. Then they will give you something called a pre-approval that says, we've looked decently close at your information, and we think you're probably eligible for a loan of this size at this rate. And so the reason why sometimes it's worth getting a pre-qualification or a pre-approval when you're going into the home buying process is that in a market like in the Bay Area, where it's very competitive, if you have not started the process looking at loans and getting an idea of what you're likely going to be approved for, you do not have nearly as much of a chance of securing a house than someone who's already done the homework. So if you go in and you haven't applied for a loan at all, a seller is probably not going to take your offer or your bid very seriously. But if you have gone and you've looked, spoken to a lender and you have a pre-approval letter for a specific amount at a decent rate, you attach that to your offer or your bid on a house, you're more likely to get some consideration from that seller. So think about that if you're still going out and thinking about putting a bid on a house. You're probably going to have a stronger bid with a pre-approval, at least in places like the Bay. It's not as important in some housing markets where it's not as competitive, but in a competitive market really helps. That being said, a pre-approval or a pre-qualification is not a guarantee that you're eligible for the loan. It is not a guarantee that your loan will close. So even if you have a piece of paper from a lender that says you're pre-approved for this amount at this rate, once they really dig in during the loan review process, they will look even more thoroughly at your credit report, at all of your debt to income ratios, at all of that information we already talked about. And even though they may have given you a pre-approval letter, there's still a chance they could deny your loan because they found something extra during the loan review process. So just keep that in mind. Don't be caught off guard when you are borrowing money and you've got that pre-approval letter and you put a bid on a house. Make sure you are in constant communication with your lender to make sure you know what they're looking at, if you're hitting your targets, if there's something that you can do during the process to help your case to close on a loan. But don't assume that letter is the be all end all. You got to get through the whole process. And I hate to break it to you, but it's a little bit more painful than we'd like it to be. It's just a very stressful process, but the more you communicate with your lender, the quicker you are to respond to questions from your potential lender, the better off you will be. And then I'm going to let Fenella take over the next slide, but I just wanted to highlight the fact that your potential lender, there's several different loan structures that you might be eligible for. And I just want to make sure you are aware of that. So most people assume that a mortgage on a house is a 30-year loan. That's very common, but there's also 15-year loans or, other loan terms. So when you're being evaluated at the front end, you're going to want to find out from your lender, okay, what types of loans am I eligible for? Is it a 30-year, a 15-year, maybe both? And then they will tell you what interest rates are going to go with the various term loans. If you take out a 30-year loan, your interest rate will probably most likely be higher than if you took out a 15-year loan because you're taking longer to pay off the debt. They're going to charge you more money because if the lender has to wait longer to get their money back. So 15-year loans may be in total cheaper than a 30-year loan. However, a shorter loan is going to have higher monthly payments than a longer loan. So just when you are thinking about buying a house, one of the things you should think about is how long of a loan do I want? Do I want 30 or 15 years? If this is a house you're buying and you know you're going to be selling it in 4 years, maybe you want to go ahead and get a cheaper loan and then that has lower monthly payments because you're just going to turn around and sell the house in a few years. But let's say that you're in it for the long haul, maybe it doesn't matter as much. So think about the pros and cons of a longer loan versus a shorter loan. The other thing you should really consider is the difference between a fixed rate loan and an adjustable rate loan. So a fixed rate loan means that you get one interest rate, you are locked in, and that your interest rate of your loan stays at that rate for the entirety of the loan. That makes your loan very predictable, which quite frankly is usually the safer route to go. However, there's something called an adjustable rate loan where your interest rate fluctuates based on an index. So in your loan terms, it will say, for example, your interest rate on this loan can fluctuate anywhere between, let's say, 3% and 14%. And it's based on this particular index that they use, how the market is doing, what the interest rates in the market are, and it will base your interest rate on that. And it changes. It can change, every 6 months. And so the reason some people like to take out an adjustable rate loan is because usually the interest rate that you're offered is lower than a fixed rate loan. However, it's because it changes over time, depending on what's going on with the market, it's not predictable. And so you may find that you're in a period down the road where the interest rate is very, very high and makes the loan unaffordable. So it's just something to think about. But again, let's say that the interest rates are very low right now for adjustable rate loans. You're going to sell the house, you're just going to buy it and quickly sell it in a few years. And you think that the market's going to stay pretty stable like it is right now with relatively low interest rates. It might be worth just taking out an adjustable rate loan because you're just going to be selling soon. So it doesn't really matter if the loan changes in a few years. It's just something to think about. Although traditionally, even though there are slightly higher interest rates, I think fixed rates probably a little bit safer for most folks. And then finally, you're going to want to think about what type of loan you want. We talked about this a little bit, but are you going to take out a conventional loan, or maybe are you going to apply for one of these other loan programs where you have to put less money down as a down payment? And so when you are talking with your loan officer, you really want to explore all these options: length of the loan, type of interest rate that you're eligible for, fixed, adjustable, and how much you need to put down as a down payment in terms of criteria. So this is a lot of information, but it's stuff that you will be asked about, and you should, I just want to make sure you understand what these different elements are. So now, to help with that process, Fanilla is going to explain how lenders, in order for you to make an accurate decision or an appropriate decision for you, lenders are required to provide certain notices. And so Fanilla is going to talk a little bit about what you can expect from lenders during the borrowing process.
Thanks, Gina. So something to know about before taking out a loan are what's known as the TRID disclosures. And this is just information that lenders have to disclose before you actually make an offer on a house and consent to making monthly loan payments. So TRID is short for the TILA-RESPA integrated disclosures. And these are a series of guidelines that are enforced by the Consumer Financial Protection Bureau. And essentially what these rules do is that they dictate what kinds of information lenders have to provide to a borrower and when they have to provide this information. So this also regulates things like the fees that a lender can charge and how the fees can change as the mortgage matures. So the TRID rules apply to consumer loans such as mortgages, construction loans, vacant land loans, but they don't apply to reverse mortgages, home equity lines of credit, and loans for mobile homes and that kind of thing. And they also do not apply to commercial transactions. And essentially the goal of these TRID rules that were implemented is to protect consumers from getting ripped off by lenders and help borrowers to select a mortgage that is right for them. So they can help you to avoid unfair lending practices like so-called bait and switch schemes. That's a scenario where a lender would offer you a really great loan, really low closing costs or interest rates, and then at the last minute they'll switch the offer out and present you with a completely different set of terms and conditions when it's actually time to close. So the goal of the TRID rules is to make sure that that does not happen. And in doing that, they require lenders to offer concise fee summaries, good faith estimates, and give you plenty of time to actually read the contract and understand what you're getting into. Next slide. So the TRID guidelines, most mortgage lenders do have to follow these rules. And some of the rules include things like no application fees before they offer you a loan estimate. And like they may charge you a fee to run your credit report, but that should be it. They have to deliver a loan estimate to you pretty quickly within 3 days of receiving your application. And they have to maintain copies of your loan estimates and closing disclosures on file for a period of at least 3 to 5 years. But I guess before I get into that more, when you're shopping for your mortgage, the lender must provide you with 2 unique disclosures. These are 2 separate documents, and one is known as a loan estimate, and the other is known as a closing disclosure. Next slide. So the loan estimate, this is an estimate from the lender of the loans that you may have to pay if you actually do end up, going through the process. And this would give you the estimate of the principal, the interest rates, and the closing costs, and other mortgage features that you may qualify for. So this is usually given to you towards the beginning of the mortgage process as an estimate of what you can expect. And what's in the loan estimate, it could change from the beginning to the end, but it cannot significantly change. And the lender has to provide this good faith estimate during the pre-approval process. So one thing to do when you're shopping around for a loan is you can get a loan estimate from several different mortgage companies and lenders and just kind of estimate how much house you can afford and which lender is offering the lowest or best rates for you. Next slide. And then the closing disclosure is something that you sign on the dotted line and to finalize the mortgage when you're, ready to take out that loan. And that lays out pretty much the same ideas as the loan estimate, but this includes specific and exact interest rates, the principal amount you can expect to be paying each month, and exact closing costs and terms. And one important thing to do before signing is to compare the loan estimate with the closing disclosure and make sure that both documents are similar. And if anything has drastically changed, then you should definitely talk to the lender and ask what's going on. For example, a lot of times the taxes and insurance may be estimated on the loan estimate, and that can, change things. So you just want to be clear on exactly what's in the closing disclosure and why. And another thing to keep in mind is that your lender has to provide you with a closing disclosure at least 3 days before you sign for the loan. There must be a 3-day waiting time. And next slide. And I'll let Gina talk about this part.
Okay, so just briefly, once you've looked for a lender, you're comfortable with the lender, you have a pretty good idea of how much you think you're going to borrow. It will give you an idea of how much what your bids are going to look like, how much you're going to offer on a loan. But the other component that you're going to need to look at this time is you're going to want to look for a real estate agent. So if Leah, if you don't mind populating, I'm going to do a quick poll in terms of where if you were starting the process and you're looking for a real estate agent, where would you start? Where would you look? Okay, let's go ahead and close out that poll, if you don't mind, Leah. So it looks like most of you would ask family and friends. And quite frankly, I'm kind of in the same camp. If I were starting out looking for an agent, I probably would talk to trusted family and friends for referrals as well. And the reason why is because the more you know about a potential agent, the better off you're going to be. So if you know somebody who's had a very positive experience with a real estate agent, it will help you because you're going to want to ask of your agent a number of questions. First, is this person, do they work for a well-established or well-known real estate company? When they are going out and they're representing you when you're buying a home, the seller's agent is not only going to be judging the offer you put on the table, but is this a company in terms of an agent that they're used to working with? They've seen that they work well, things go smoothly with that particular agency. So it can make a difference. The other thing is that if you work with an agent who is from a more familiar real estate company, they probably have connections to the community. They probably have the inside scoop on good neighborhoods or generally how sales are going in that market. It's not to say if they don't work for a big agency or a well-established agency, it's not the case, but it can make a difference. The other thing is that you may want to make sure that the agent that you're considering has some type of connection to the local market. If you are somebody who's shopping in San Francisco, but you are hiring an agent who only sells houses or works on home sales in Sacramento, they're not going to know the area very well. You're probably not going to want to go with that agent. So it's really good to look for an agent who has experience working in the market that you're considering, because they will probably know the market very well, know the inspectors who come out in that area. They can really help guide you a lot more than someone who's not familiar with that market. The other thing is do your homework, ask for references. Do they, are they willing to give you references? And again, this is where it comes in. If you talk to family or friends, you really want to make sure that you can rely on the person you're about to hire. You also are going to want to know if this agent is representing just you or you and the seller. Keep in mind that if you decide to go with an agent where you just go ahead and go with the seller's agent, you don't hire your own agent, that seller's agent has an obligation, one, for the sellers to get the highest price possible for the house. And then for you, they're also supposed to get you a good deal. And it's really hard to play both sides. Usually, a little tough if you're buying a house, if you're going to go with the same agent as the seller. Just keep in mind that there might be some conflicts there in terms of interests. A big thing with your real estate agent is this someone with strong communication skills? They are going to be speaking on your behalf. If you have questions about the house, if issues come up, if you need to negotiate for more time, if something is dragging on with the lender, you really want an agent who can communicate clearly, who can communicate exactly what you want to say to the potential seller. And you want an agent who's also clear with the potential lender if they're going to be involved with the lenders at all. So you really want someone with strong communication skills. And even more importantly, you really want someone who's very detail oriented, organized, and proactive. You do not want a real estate agent who kind of goes with the flow. You want somebody who, if your lender is taking a long time, or if they need a better idea of how much time it's going to take to close on a loan, that they are calling up the lender and getting on their case just as much as you are, and that they are proactively anticipating any potential problems with closing on that loan. You really want somebody who's paying very close attention on your side. And then you also want to make sure that you get along with this person. You're going to be going through a very stressful process, and you want to make sure you get along with your agent, and also making sure that they understand, what are your priorities in terms of budget? Are they pressuring you into homes that you're not comfortable? You think they're too much? Do they understand your aesthetic? You really don't want your agent pushing you into a home purchase that's really not what you want, because this is a very big decision. So you want to make sure that you can trust your agent and that they're not pushing you in the wrong direction. And then finally, I will just say this for agents: you also should do your homework and make sure that you look up your potential real estate agent on the California Department of Real Estate website. Every real estate agent who's licensed should be licensed. They have to have their information available on this website. You can look up if they've had any disciplinary actions or any issues. So if you are thinking about hiring someone, but they've had a lot of disciplinary issues, you're probably not going to want to hire that individual. So just make sure you do your homework on the front end. All right. And then last but not least, we're going to talk about some of the pitfalls or other issues that you may face while shopping around for a home. Fanilla's going to talk about that, and then we'll leave room for questions.
Okay. Thanks, Gina. So one thing to keep in mind is in a state like California, where there are so many people that speak other languages, particularly Spanish, it's important to know about California Civil Code 1632. And that provides that if you negotiate a contract in Spanish, for example, without using your own interpreter, then you're actually entitled to receive a translation of this contract before you actually sign it. And if a lender violates that law, or if there's any violation of this law, then you're actually you're entitled to cancel the contract. And this applies for Spanish speakers, but it also applies for those who speak Chinese, Korean, Vietnamese, and Tagalog. Next slide. And when buying a house and looking for a loan, there are a number of scams out there that I want you all to be aware of. And here are just a couple of examples on this slide of just some warning signs to keep in mind and to look out for. So for example, if you're shopping around for a loan and approaching lenders, and one lender offers a really high interest rate and really high fees compared to other lenders, then that's something to flag to yourself. Like, why is this lender offering a loan with such bad terms compared to all of these other lenders? And that's another reason why it's really important to shop around for your loan and approach multiple lenders. Bait and switch tactics, which we talked about earlier, where a lender offers you one set of terms and then pressures you to sign a contract with different terms and hidden fees. That's something to look out for. Then, of course, there are door-to-door high-pressure salespersons that might approach you and pitch you to take out a home equity loan for home improvements or something like that. These kinds of salespersons can do all kinds of things to try to win you over and gain your trust, lull you into a false sense of security. They may ask you questions, about your kids or where you went to school, and just try to, become your friend and have you make a decision based on trust instead of knowledge and understanding. So, that salesperson might try to make you sign a contract right away. and say you have to sign it today. The offer is only good today. But, if any deal should probably be good tomorrow after you've actually had a chance to review the contract and consult with a knowledgeable and uninvolved advisor. So these are just high pressure sales tactics to keep in mind and look out for. And so rent to own is another scheme to look out for. This is a situation where as a tenant, you're allowed to rent a property, but then you're also given the option to buy the property before the lease actually expires. These aren't too common, but these are offered, so it's something to keep in mind. And it sounds like it may be a good deal. Next slide. And it allows, it allows you to get an exclusive option on a house that other buyers might not receive. And you might think, oh, you can start paying towards the home purchase, even if maybe you don't qualify for a mortgage yet. Maybe you need more time to save up for a down payment or get your credit in check and all of that. So those are, some benefits to a rent to own scheme, but there are a lot of risks associated with these kinds of schemes. For example, you'll probably end up paying more in rent every month than you would as a renter. The landlord, may not credit your full rent towards the purchase of the house. There are a lot of upfront fees. Most of these types of contracts require a non-refundable upfront fee. Typically that's 3 to 7% of the agreed upon purchase price, and that can add up to a lot. And it's just really important to read a lot of the fine print on these types of deals, because there's a good chance you're actually paying less towards the house price than you'd think. You might also lock in at a bad valuation of the house. You may, in the Bay Area, it seems like a lot of the house prices are going up, but in other markets, maybe the house prices are going down, and you may be stuck with the price of the house years before you actually buy it. You may also have to pay for all repairs and maintenance and that kind of thing. So generally, rent to own is not an ideal path to homeownership and often doesn't actually lead to actually buying the house. Next slide. Another type of agreement to watch out for are things known as equity share agreements. So these are often, this is a type of agreement that allows another party, such as a city, to invest in your property and actually acquire a stake in its future equity. These types of programs are also known as shared appreciation mortgages or SAM loans. And some places that offer this type of program are San Francisco and Walnut Creek. And this essentially would allow you to receive a lump sum payment, which can help you, maybe afford a bigger down payment or pay down other closing costs or that kind of thing. But the homeowner is not required to actually make any payments on this until you sell or refinance the house. And at that point, the homeowner would repay the principal value of this equity share loan, as well as a percentage of the property's increased value or appreciation if the property has increased in value. So next slide. Okay, well, in terms of the benefits and risks of this type of program, often this can increase your buying power with a larger down payment. And you may be able to lock in a better interest rate or reduce your monthly mortgage payment on your first mortgage. But it could actually be risky in that it could actually cost a lot more than a conventional mortgage. So it could actually end up costing a lot more than a typical mortgage because it's based on the equity increase in the house. So here's an example of how this works. So if you were to say buy a house for $200,000, I know that sounds ridiculous in this market, but back in the day, houses actually were this cheap in some places. If you were to buy this house for $200,000 and then you were to sell it 10 years later for $300,000, that means that the house appreciated in value by $100,000. So if you were to, and if the equity lender had contributed $20,000 to begin with when they bought the house, then essentially you would add the principal loan, the $20,000, plus 10% of the appreciation, which is $10,000. And then you'd have to ultimately pay $30,000 of a total payment on this equity share loan that you took out. That doesn't seem so bad in this example, but in the Bay Area, for example, if you bought a house for $200,000 in like 1990, and now the house is worth, say, like $2 million, which is not an unlikely scenario, then the appreciation would be, 1.8 million, and 1.8 million, 10% of that is, I think, like $180,000. So you'd be looking at paying $180,000 plus the $20,000 that you contributed, and you'd be paying $200,000 on this loan when you had originally just when the lender had originally just put in 20,000. So that's a huge increase, and that's an example of how these types of loans can actually become very expensive and just something to watch out for and consider if you are thinking about this kind of loan. Next slide. And I'm go back to the previous slide. So there's another poll, I believe the last poll. If we could pull that up. Now we're going to get into talking about fair housing and the Fair Housing Act, which does apply to mortgage lending. And I wanted to test everyone's, basic understanding of the Fair Housing Act and what you think is protected from discrimination under the Fair Housing Act. So if everyone could, take some time to, consider these questions, and just want to get a feel for what people consider is, protected from discrimination under the Fair Housing Act. Okay, so yeah, a lot of these categories do sound a little bit similar, but the protected classes under the Fair Housing Act are race, sex, disability, color, national origin, religion, and family status. So, and essentially, the Fair Housing Act protects people from discrimination in these categories when they are renting or buying a house or getting a mortgage or seeking housing assistance and that kind of thing. So when you're taking out a loan in particular, the types of discrimination that are prohibited or the discrimination that is prohibited in loans are for, when you're securing a loan in residential real estate, or when you're trying to purchase, construct, or improve or repair a dwelling. So this includes things like mortgages, refinances, home equity loans, and home improvement loans. Next slide. So like I mentioned before, it's illegal discrimination to take any of the following actions based on race, color, religion, sex, disability, family status, or national origin. So some examples include refusing to make a mortgage loan based on one of these protected classes, refusing to provide information about these loans, imposing different terms and conditions on a loan based on one of these 7 protected classes, such as providing you with a different interest rate or points or fees, discrimination when it comes to a home appraisal, or refusing to purchase a loan, or conditioning the availability of a loan on someone's response to harassment. Next slide. And here are some other examples that you might see of lender discrimination. This could include, denying someone a mortgage or charging you a higher interest rate because your house is located in a majority minority neighborhood, or providing you with a different customer experience, based on one of the 7 protected classes, refusing to consider your disability-related income, such as SSI or your Social Security disability income, or perhaps you might be steered to a loan with less favorable terms, or targeted if you live in a minority community for fraudulent home loan modification assistance. Things like that are, examples that you might want to keep in mind. I will say that, oftentimes, if you do feel like you might be facing lending discrimination, oftentimes it's, not clear cut and can be hard to prove. So I would say, keep records of written communications with your lenders and notes and that kind of thing. Next slide. So if you think you have been a victim of lending discrimination or discriminated against at all during the mortgage process, you have a couple of options. You could contact the Consumer Financial Protection Bureau and submit a complaint to them. And the website is listed here. You could also submit a complaint to HUD, either on their website or by calling these numbers. And you can find out more information about your rights and submit a complaint on the CFPB's website, on fair lending. And you can also contact HERA if you have any questions about any of this and kind of want to talk through your options. Gina?
So just before we end, sorry about my computer freezing, but I want to go through and make sure that we answer any lingering questions. I know this was a lot of information, a lot of things to think about, but I'm going to go through for the next few minutes and answer any remaining questions. So if you want to ask questions, please throw them in the chat, and I'm going to go through and make sure and see if we have any lingering questions here. So some of these questions, if they're super personal, I'm not going to read them out, but let me see here. So it sounds like some questions that may pop up is if you're reviewing your credit report and you see something that maybe an ex-spouse pulled or is still active, this is the type of thing that you should get a one-on-one consult with HERA. We can take a look at your report together. We can talk about the legal obligations you have to various debts. If you're seeing something on your credit report that you need to address before taking out a home loan, this is one where you're going to want to get a one-on-one consult. And so this last slide tells you all of the different issue areas that we work on. Our services are free, so I strongly recommend that you talk to an attorney one-on-one. We go over credit reports together. We can answer individual lending questions. Let's say you get a loan offer and you're really not sure you understand it. We're happy to go through it with you. So, feel free to reach out to our office if you want a one-on-one consult. A few other comments I see here. There was, I think it's more of a comment than a question about the prepayment of property taxes as a closing cost. As I mentioned, yes, lenders do usually roll in prepayment of property taxes. You're also responsible for a pro rata share. So if the seller has already paid for some property taxes, let's say they've already paid for the next 4 months, or I guess it would be 6 months property taxes, but then they're selling the house to you before that period is over, you need to address that and pay for your portion of the property taxes that you're going to be taking over. And then I don't see any more questions, but if there are, I'm going to wait here for a few minutes. There was one other thing that I thought is worth mentioning, because I think the main point of today's presentation is to really get your credit in order and check out your finances. Shop around for lenders. And on the note of shopping for, there's the question that I was hoping someone would ask. So when shopping for different lenders, do they do credit checks every time? And if they do, is it on the credit report as inquiries? That is a fantastic question. I'm glad you asked. So yes, lenders do. If you are applying for a line of credit, or if you're applying for something like a pre-approval, then they are going to pull your credit report and it is going to show up on an inquiry section. The one thing that's good to know about home loan shopping versus any other type of loan or credit card is that if you can do all of your shopping for a potential lender within, let's say, a 2-week, they say up to 45 days, but I always say keep it to 2 weeks. If you do all of your shopping and stick to a 2-week period, submitting all your applications, then lenders are supposed to only count all of those applications as one application. So let's say that you submit 5 applications for potential home loans in a 2-week period, it should really only show up as one credit pull on your credit report. And the reason they do that for mortgages as opposed to, let's say, credit card is because they're expecting a responsible person is supposed to go and shop for a mortgage. You want to shop for high priced items. So they don't hold it against you if you're shopping around for different mortgages. And so they try and say, okay, if you submit all the applications within this small window of time, we'll count it as one. I think they also do that generally for auto loans, but definitely for mortgages. So if you're going to shop around, get all your paperwork in order, get all of your documents lined up, save them in a folder on your computer, and apply for all of them. At the same time, do it over a weekend, because that will really help you and not have a bunch of inquiries on your credit report pulling down your score. I see here it says, how good is a pre-qualification letter good for? 30, 60, or 90 days? That's a really good question, and it depends on the potential lender. Most of them are going to make those letters good for 90 days, but you're definitely going to want to ask that particular lender. And quite frankly, usually the letter will say. But that's also something to keep in mind. If you're just shopping casually for a loan and you're not ready to put a bid on a house yet, you may not want to get a pre-approval letter or have them pull your credit report quite yet, because you're not quite there. Once you're really ready to put and bid on houses is really when you want to get those potential offer letters on the table, because they do expire, or rates only lock in for a certain amount of time. So keep that in mind if you're shopping around. Let's see.
There's another question farther up.
Yeah.
Maybe just came to us. That's about something that was on a credit score from 2010.
I did a summary for that one. So if you're looking
did.
at your
Okay.
credit report and you've got something from 2010, one, no matter what the background is for a really old item on a credit report, if it's more than 10 years old, it really shouldn't be showing up. That's something that you're going to want to just send a dispute letter to get the negative information off. But in this example that was posted here, there may be an extra layer because it's related to an ex-spouse. So there's probably some family law pieces in there as well. So it's always good just to be really sure to talk with an attorney. Feel free to call our office to make sure that we're looking at it from many different angles. But in general, something that's 10 years old really shouldn't be showing up on your credit report.
Thank you. And I'm putting your contact information in the chat.
I see, what is a good range for good credit score for home loans? I get this question a lot. So most lenders, this is a typical lawyer answer. It depends. If it's a very competitive market like it is now, some lenders, to get prime rates for a mortgage, you're going to want to be in like the very high 700s, or better yet, 800s. In markets where it's not as competitive, anywhere in like the 720 and above range, you're probably looking at pretty good mortgage rates. But right now, because it's such a hot market, because everybody's looking for a loan right now, if you're in the high 7s to 800s, that's really ideal. You're going to be looking at prime rates. Things that's 750, 720 or lower, you're not going to be quite as good in terms of the interest rates you're offered, but it kind of depends on the market. It says, what county do we serve? Is it only Alameda? No, we serve actually all of California. So if you're a California resident, feel free to call in. We're based in the Bay Area. We're based in Alameda, but we do serve all across the state. And then it says, how do we access your services listed? So on this last slide down below, you'll see our telephone number. If you want to get an appointment for a one-on-one consultation, call that number and do extension 300. That is our intake line. So feel free to give us a call, or you can email us at inquiries@HERA.org, HERA.org. Beth has put it in the chat for us. Thanks so much, Beth. And you can contact our intake line. It usually takes us a few days to get back to people to set up appointments, but our paralegals and support staff are really good about returning calls within a few days. So just be patient with us, and we're happy to help you out and give you some feedback. Do we have any other questions? Kind of last opportunity, anything that we didn't cover that you were hoping to get answered today?
This is such a great training today. Thank you guys so much. Want to let everyone know that we will be putting this recording up on our YouTube website, and you'll be getting a link to that. So if you want to share it with other people, you want to watch it again, you want to remember some of the information, And then also we have the links to the materials, and we'll be sending that out to you again as well. So thank you so much, Vanilla and Gina. It's just been great. I'm going to remind everybody, we appreciate you being here today.